and then
Shoulvin.
Lynn.
All right, cool. So, welcome to today's podcast. Thanks for joining me as always. I really appreciate you listening, and hopefully, you're getting a lot of education from this. And sometimes I'm here by myself, but thankfully, I tend to want to bring on guests and experts that I've grown to appreciate and trust that can shed some light on their world that hopefully helps you on your financial journey of life. So, today, I am honored to have Kyle Shoulvin into the Perennial Pride podcast. He's an independent insurance broker and agent with Charter Oak Agency, and I got to meet him over the years. And he's a local guy, so maybe next time we'll do this live and not on video, right? We'll kind of maybe be in the same room, but. Kyle, I really appreciate you coming on the show and then sharing your expertise and wisdom with the Perennial Pride audience.
Tom, thanks so much for having me, and any of the Perennial Pride audience that I don't already know, I would like to introduce myself, and again, thanks for having me here. I'm excited for what should be a fun conversation.
Yeah, and we were joking before we started recording. Yeah, nobody really loves to talk about insurance, and it's funny, even in my side of some of the things I work on, say, whatever, life insurance or disability. Nobody probably envisioned themselves in this industry, in insurance, right? It's not like they were growing up saying, I need to be an insurance broker, right? That was not the dream of most people, but, sometimes things find you along the way. So, Kyle, I know you have an interesting background before we kind of get rolling into any of the details of it, but tell us kind of how you started, because I know you were like a teacher and coach and other things before even getting into the insurance game. Tell us a little bit about that.
Yeah, there's no doubt. And it's funny. It's a conversation I have regularly. I actually had about an hour or so ago with another agency owner that we are friendly with who popped into our office, as well as a number of agency owners that I spoke with yesterday at one of our carrier events for a March Madness kickoff little happy hour. And it so often comes up that insurance is a wonderful industry. It's great to be in it, but no one goes into their whether it's their college education or even their first job thinking I need to get into the insurance industry. It's certainly far from a sexy or glamorous industry, but once you're in, like in so many products, it's a great industry. It is something that, as we typically say, we're selling advice, and we're selling we're selling something that truly everyone has to have. There's no need. There's a true need as opposed to a want, which is always a good thing. And honestly, there is such a lack of education on the insurance world that I can really utilize my teaching and coaching background so often. So as you mentioned, Tom, when I first graduated college, I went in and I was an elementary education teacher. I taught for 5 years at a few local elementary schools, enjoyed a lot of it, especially the work with the children themselves. Unfortunately, with the way education was going, this is about 9 years ago that I made the change, but as I saw the direction of the education world at the time, I wasn't overly interested in continuing with it. A lot of the creativity that I associated with teaching growing up had started to be stripped out of the classroom, and figured it was time for a reset. And for me, I took about 4 to 5 months exploring my network and seeing, what do people do? What is everyone, who I admire, from a work ethic perspective and a personality perspective, and seemingly doing well financially, reaching out to probably ended up being about 100 different people and poking their brains, asking them, what do you do? What does a day in the life look like? And what did you need to do to get there? What were the qualifications? What were the degrees? What was the experience needed? And in doing that, especially in this portion of Connecticut where so much of it is financial services related, it was a lot of people in financial advising, it was a lot of people in insurance, a lot of people in accounting, and a lot of people in law. You start looking at what is the best path forward, or what is the path that I can get on the quickest to make a real impact, and insurance was certainly in the top two when it came to that. So as you had mentioned, it was about 8.5 years ago, I joined Charter Oak Agency, which at the time was located in Darien, Connecticut. We have recently moved up I-95 a little bit to Westport. But we are a property and casualty insurance company, so we work with individuals, families, and small businesses on their property and casualty insurance. So unlike you, we don't do any life, we don't do any health, we don't do any disability. We are here to really fill the P&C gap, and so much of that is tied into education and working with centers of influence and clients on making sure that they have the right risk management strategy in place.
Yeah, that's great. In the unfortunate world we live in, and even though we want control, like I think everyone, if you ask them, hey, I want to control my life, I want to control things, but when you peel back, the reality is there's a lot we cannot control, and for the lack of it, the bleep happens all the time, right? You can't control it, and so that's why these protections are so important to have way before they ever happen, because we can never really predict those sorts of things, right? Whether we die or our car breaks down or we get into an accident or your house burns down, and this is the type of stuff we're going to talk about a little bit more, because there's obviously a lot of stuff in the news recently of things in the industry itself and where it's going. So definitely would love to get your thoughts on it. But one of the things that which strikes me, because you see enough around the types of companies that are maybe advertising like crazy, right? The sort of mainstream, like a State Farm or a Geico, and you work for an independent firm. Like, why did you go down that path?
Yeah, it's a great question, and you're right. So often, if you are not in the industry yourself, but you're just a consumer of life, and you are watching television, reading magazines, listening to the radio, you're getting inundated on a daily basis from insurance marketing and advertising. And 95% of those companies that are doing the advertising and marketing are direct writers. So what that means is they are not only selling the policy, but that they also hold the policy itself. So in the event that you need to make an endorsement, that is on their paper. If you need to file a claim, that is on them. They are the insurance company itself. Whereas for me, I'm an independent agent. And truly, the vast majority of insurance companies do not write policies and then sell them directly to the consumers. Instead, they utilize agencies like ours that have a hyper-local connectivity to their community to be their agents, to be their sales force. So what we do is we contract with 15 to 20 different insurance companies that then give us the parameters and give us binding authority to go out and write policies for them. These companies are large. They're all AM Best rated, which is the financial service ratings for insurance companies. They're all rated A or higher. They've all been around for decades, if not centuries. And some of them do have name recognition to the general consumer because they're included in the S&P 500, because they are Fortune 500 companies. Others of our companies are not, because they're more regional or hyper-local to the Northeast or to the Mid-Atlantic, and they really only serve their clients in that area. So these companies that we insure, that we write insurance policies for, they have wonderful actuaries, they have great claims adjusters, they have underwriters, and they have a small amount of sales and marketing individuals who work with the agencies themselves, but they don't have any salespeople that sell direct to the consumer, and they don't have a customer service team. So that is what they contract for us to then do, is we put all those policies in place, and then once we write a policy, we are that point person for the client. So whether the client has a question about coverage, needs to file a claim, needs to make a simple change, needs to process a payment and can't do it themselves, that all comes through our agency. And you had mentioned, what was the choice between the direct writer versus going to an agency? And really, the telltale sign is variety. The direct writers, they have their market, right? They have a certain client that they want, and that is what they focus on. And when you're with the direct writer, it's the only company you're writing, so you can't leave that box. All of our insurance companies also have a certain client they're going after, but that client varies a great deal from one company to another. So especially in an area like Fairfield County or even the greater tri-state area, we have clients from all walks of life, whether they are commercial businesses or individuals or families. They all can range so dramatically in terms of what their insurance needs are. And by having so many insurance companies, we're able to fill those needs. So that is really the main reason why I went to the independent agency side, is not only do I really like the companies that we partner with, but it allows me to serve our greater community as opposed to simply just going after one individual client that fits into their underwriting box.
Yeah, I love it. Yeah, and I think that's where we are aligned in a lot of ways that way. And be able to have a lot more tools and options to sort of cater to and tailor solutions for folks based on kind of their situations, because it isn't one size fits all.
No, it's not. And in terms of that, oftentimes when you're working with a direct writing company and you call their 1-800 number, they're people who are answering the phone. They're not licensed insurance agents. They're typically a customer service representative from the company. So they're not there to advise you. At the end of the day, their interest is tied to the insurance company, whereas for us at an independent agency, our loyalty is 50-50, right? We are loyal to our insurance companies because they give us the ability to write their products, and then we're also loyal to our policyholders to make sure we're giving them the right advice and pairing them with the right insurance company. So at the end of the day, our entire value is based on trust. The insurance companies have to trust us that we are going to find the right clients for them, and then our clients need to trust us that we're going to find the right insurance company to partner them with, so that in the event of a claim, they are going to have as little headache as possible. And just because you initially start someone with one company doesn't mean they're going to be there for the next 5, 10, 15 years. People adapt and change on such a regular basis that as their scope changes, their insurance plan needs to do so with them.
Absolutely. No, that's actually a key point. So let me touch in, because I know you do both personal, right, families, and then business. So let me break it up. Let me start on the simpler side. Well, maybe you tell me, right, the personal side of things. And I was joking before we started recording. A neighbor of mine had a incident with their car, and their windshield broke, and they checked their policy. They didn't have window coverage, so they had to pay for the whole thing out of pocket. Nothing was covered. And it's just they hadn't looked at their policies in so long. They didn't know what they had or didn't have. And I would imagine that's probably a common thing, and that's why it's so important to check on them occasionally, right, whatever that amount is, and have a good advisor like you to help then, and broker to help you review it. So let's start on the personal side. So just at a broad strokes, with most of the common sort of coverages that you would cover folks for?
Absolutely. So when we're talking about the personal line side, so those would be the property and casualty insurance policies for individuals, couples, families, right? So the most basic policy that everyone needs, typically when they're first out of college, would be a renter's insurance policy. That's usually the introduction to the world of property and casualty for most individuals. And you keep that renter's policy as long as you are a tenant. Typically your lease will require that you have a policy in place. And then from there, people will soon thereafter, purchase their first car. So we get into the auto insurance world. As people get a little bit older, maybe an engagement is on the horizon, and all of a sudden people are reaching out because they're looking to insure their engagement ring or a wedding ring. And then as people go from there, people buying condos, people buying co-ops, people buying homes, people buying multifamily homes. People are also buying homes that they're never going to live in. They're buying homes that they're renting to others. And as long as it's in their individual name, or as long as it's under 2 units or less, we're putting those on a personal lines policy. You get into more niche insurance policies depending on where you live and the wealth in which your client base has, but we write a great deal of watercraft policies. You write a lot of umbrella policies, which are excess liability. We write a lot of, not a lot of, but you write on the occasion aviation policy. So each one has its certain niches and its certain coverages that are extremely important. But I think as I had mentioned earlier, your property and casualty insurance policy portfolio is going to change a great deal as your life goes on. Because again, you're probably coming into different amounts of wealth. You're taking on new liabilities. You want to make sure that all of that risk is protected against. But at its essence, property and casualty insurance policies provide 2 main coverages. They have your property coverage, which is to insure your physical assets, right? So whether it is in a simple renter's policy, you may have a couch and some dining ware and clothes and a television that, heaven forbid, your unit catches on fire. You're going to want to make sure that the insurance policy is going to replace those. As you buy a home, obviously that personal property coverage limit's only going to grow because you have more rooms to furnish. The other portion, and in my argument, the most important portion of property and casualty insurance is your liability coverage. So that is what is triggered in the event that you are sued, either for property damage, bodily injury damage, or it could even be something like libel, which in today's world is becoming more and more important. So it's making sure that your assets are protected through the liability coverage itself. And so often, the way I gear it, and I know the way you look at it, Tom, is that your property and casualty insurance policies really need to work in concert with your financial plan. Property and casualty insurance needs to be a snippet of everyone's financial plan, because as you're growing your assets and you're looking to invest them and you're looking to get returns, you also want to make sure that those assets are protected from the event of a lawsuit, especially in today's litigious world. Yeah,
no, absolutely. And it's, those sorts of things just seems like a growing in sort of prevalence as this world gets a little bit crazier, and unfortunately some people are going through some more hardship, so like they try to find these ways to not blame, but certainly there's some cases you're trying to blame somebody, right, and recoup assets and money. So it's just, I don't think that's going away anytime soon. So especially as you're growing wealth. And that's why sometimes I come across folks who say, I don't have a lot to cover, so why would I get much insurance, right? What would you respond with that?
Yeah, it's a great question. People often, I think just us as a society, we always try and downplay everything, right? That's, self-deprecating humor is something that I enjoy and many others do, and I think it transfers into the way that we speak about ourselves and often the way that we underestimate what we do have in place. And when it comes to a property standpoint, someone could be right. Maybe you're renting a one-bedroom apartment and you don't have many, you don't have a great deal of personal property. Maybe you really could replace it all with $15,000 or $20,000 of coverage. Makes total sense. Maybe even if you do buy a 4-bedroom house, at the end of the day, a lot of people will say to us, look, I could go to IKEA, or I could go, to Bed Bath & Beyond if they're still around, or anywhere else, and replace everything for $100,000. And maybe that's right. It totally could be. The items that you want to make sure are mostly insured against are the sentimental values. So anything that you have that is going to be, an heirloom, something that has any sort of value to you or your family, whether it's financial value or just intrinsic value, that's what's most important to be insuring from that standpoint. When it comes to buying a condo or a co-op, it's a little bit unique because you're not insuring the physical structure, right? So often the HOA is going to be in charge of insuring the physical dwelling itself, but what you would be responsible for, and it can change, so it's always extremely important that you're reading the insurance guidelines of the HOA to see exactly when their policy starts and when their policy stops and when your policy needs to start. But often we refer to it as drywalls and in coverage. So once you get past the studs and you're entering into the drywall, that is where the condo or co-op owner would be responsible for insuring. Same thing if you're a small business owner and you're renting or owning a commercial condo. It's so important to look at those leases or those HOA contracts to get an idea as to, okay, well, which portion of this am I responsible to replace in the event of damage, and what portion is going to be handled by the HOA itself. Because so often you overlook and underestimate what those values are. And with a co-op and a condo, you can kind of, well, depending on the insurance company, you can determine what value you want to set aside for the interior of your unit. A homeowner's policy is a little bit different because the vast majority of insurance companies, when they're going to take on a new homeowner's policy, they're going to run cost estimators with up-to-date building costs to say, okay, this home in this zip code of this square footage, this number of bathrooms and kitchens, and this sort of roof, and this sort of style home, what is it going to cost us to rebuild in the event of a loss? So often people will call us up and they'll say, hey, I'm buying this house. It's going to cost me X number of dollars. We'll then go out and we quote the insurance policy, and we come back and the dwelling coverage limit is not the same as that purchase price. And they look at us confused. They said, oh no, I'm buying this house, let's, round numbers. I'm buying this house for $500,000, but your insurance quote has a dwelling coverage limit of $600,000. And we have that conversation with them and we say, well, the insurance companies aren't overly worried about what your purchase price is of your home, right? At the end of the day, they care about rebuild costs, because in the event of a total loss, heaven forbid that house gets blown over tomorrow in a windstorm, the insurance company is responsible for rebuilding that house to its exact specifics prior to loss. So the real estate value is irrelevant. At the end of the day, they need to determine what is it going to cost us to make sure that we rebuild this home and meet the requirements of this contract. So we utilize those cost estimators, and so often the insurance companies will go out and they'll do an inspection of the home that they're insuring, right? Sometimes it's just an exterior where they'll walk around the outside, make sure they get a good understanding of the house, make sure there's no risks that present, extra liability concerns, and ensure that everything is in the up and up and that it met all their underwriting requirements to make sure that, hey, okay, we are accurately insuring this home, and that in the event of a loss, we are going to be able to rebuild and put these people back on their feet.
Yeah, no, and it's a stark sort of reality, and I know, I don't know how closely, I'm not following it as detailed, and maybe you have more insights around it, like all the pain that, folks in LA had to suffer through their homes, and, I know horror stories of people with no insurance because they couldn't get coverage or it just got too expensive, and so you kind of roll the dice, right? You kind of quote unquote self-insure, which to me is kind of bogus.
It's a really tough call, and obviously the people in California have been dealing with it from a wildfire perspective, and then you're seeing a lot of our neighbors to the south in Florida as well as other southeastern states dealing with it from the hurricane and flood insurance perspective. And to give a little bit of background on this, if you have a mortgage on your house, your lender is always going to require that you have a homeowner's insurance policy in place. It's always one of the requirements for having that loan. And if you can't procure a policy or find a policy yourself, the lender will place the policy. They'll force place the coverage so that you can at least they have enough coverage that in the event that the home is totally destroyed, they're going to make sure they recoup the outstanding balance on the loan itself. So these policies are very scaled back. They're not for the homeowner, they're really there for the lender themselves. And quite often, even though the policies are very scaled back from a coverage perspective, they cost a great deal of money. So it's never advantageous for a consumer to allow their lender to force place their coverage. It's always better if they can find the coverage themselves. Now, in areas like California and like Florida, as well as a few other states, coverage is becoming more and more difficult to procure. It's not the same insurance market as it is here in Connecticut, where really most companies want to do business because at the end of the day, even with the changing of the climate, the safety of this area has still been very strong. In those areas, a lot of insurance companies over the past decade have pulled out or have consolidated or greatly reduced the number of policies that they're willing to issue, because at the end of the day, insurance companies are looking to make an underwriting profit. And if they don't see a way to do that, they're not going to continue to offer coverages in those areas. So what happens is the state has to then step in and they have to find or make a fund to insure their constituents, right? So in California, the policy of last resort is called the California Fair Plan. And if you cannot find a policy on your own, you can tap into the California Fair Plan and get a very basic homeowner's insurance policy. It's not going to be like a standard homeowner's insurance policy that the vast majority of people would purchase. The coverages are going to be very scaled back. They're often not going to provide nearly enough coverage to actually rebuild a home, and there's certainly not going to be any extended replacement cost coverage on a home. So what a lot of people are finding out who had the California Fair Plan policy is that their coverage is not going to be sufficient. They're not going to be able to use that money to rebuild their homes, unfortunately. And then when a natural disaster strikes an area, the inflation hyper-locally is only going to go through the roof. The cost of materials and labor and your architects and getting on a building schedule is going to be a lot more difficult than if you lived in an area where just one home was damaged. Let's say there was a home fire. Okay, yes, that home unfortunately burns to the ground, but no one else in the community had their home damaged. There's not going to be a rush on all of the trades to rebuild that house. They're going to be able to have their pick of the litter, and it's going to be able to happen in a timely fashion. But as we saw in Palisades, when all of these homes in a small area are destroyed at once, it's going to take a really long time. There's going to be a lot of pain and suffering with that. And then, as I mentioned with Florida, flood insurance policies are policies that not everyone is required to purchase, but if your home is located in what is deemed an at-risk flood zone, your lender will also require that you purchase a flood insurance policy, whether it's a FEMA-backed policy or a private market policy. But unfortunately, just because your home's not in an at-risk flood zone doesn't mean that your home is not going to be flooded. So if your home is not in an at-risk flood zone and you haven't purchased a flood insurance policy, but your home sustains, flood damage, whether it be tidal, coming from a lake or an ocean, or just being a heavy downpour in a small area, and all of a sudden your basement is flooded, your standard homeowner's insurance policy is going to exclude any coverage for that. So you really do need to have a flood policy to actually be covered. And what we're seeing is a lot of people whether they're in a flood zone or not, they're having flood damage. And if they haven't had a mortgage on their home and they are in an at-risk zone, a lot of people are going without flood insurance coverage because the cost has been too much to handle. And so they're passing on that cost, and they're self-insuring, which at the end of the day, unfortunately, typically ends up costing a lot more.
Yeah, I always joke around that because people always say they self-insure, and I said, well, if you have all these assets, you mean you're not using them for anything? they're set aside to reserve to protect you, right? No, they're using them. They're investing them. They're putting them in play. I mean, but that's why I always joke and people complain insurance companies, make too much profit. And I said, I want them to be profitable so they can pay,
right?
And operate.
The most important thing of any insurance company is their ability to pay the claims they need to. And that's what I always implore people to look at whenever you're considering an insurance company, whether it be for a personal insurance policy or for a policy for your business. I can't stress enough how important it is to look at the AM Best rating. So A is in Apple, M is in Mary, Best. And it is a financial tool that is there that totally assesses insurance companies. They are the ones who go through all the financials and then give them a score based on their ability to pay out claims. And it is so important to work with a carrier that has either an A- or higher AM Best rating. Once you get below A-, it just starts to get a little bit murky. And just starts to put yourself in this position where you have to start asking, well, what am I paying for? I'm transferring risk, right? At the end of the day, that is the goal of insurance, is you transfer risk from the consumer to the insurance company based on the promise that in the event that the policy is triggered, the insurance company is then going to come in and pay for the claim. So you're paying a little bit of money for the possibility of utilizing a lot of coverage. Now, a lot of people will complain to us, I'm sure you've heard it before, Tom, too. It's, hey, I pay these policy premiums every year. I don't use it. I said, well, that's great. At the end of the day, a claim, whether it be an auto claim, a home insurance claim, heaven forbid, an umbrella insurance claim, watercraft, jewelry, whatever it may be, claims are nuisances on everyone. They're time consuming. They can, force you out of your home or away from a vehicle for an extended period of time. They're not enjoyable for anyone. So no one should ever want to set out with the idea of, I hope I have a claim this year. I hope I use this policy. No, insurance policies, what I try to stress to people, especially homeowners policies, these are catastrophic policies, right? So I am a big believer in you weigh out different deductible options and see what those corresponding premiums are. And if it does make sense, go with the highest deductible. If it's going to save you some money on premium, because really, hopefully you don't ever have a homeowner's insurance claim. You have this policy as peace of mind so that when it's super windy at night, I can put my head on the pillow and fall asleep, not worrying about heaven forbid a tree falls on my roof, or heaven forbid shingles get ripped off of my roof because of this wind outside. I am able to sleep and be able to have that peace of mind because I know that at the end of the day, I have that insurance policy if need be. But this is not health insurance, right? This isn't something that you're supposed to use over the course of the year. This is something that you're really putting in place as a financial tool to protect your assets and make sure that, heaven forbid something goes awry, you're not going to be paying a great deal out of pocket.
No, absolutely. So, if you think about it from, when you've seen, you're dealing with a lot of different families and situations, is there any recurring sort of themes that you see that people are just ignoring or misunderstanding the risks associated with it that you're seeing as you're kind of reviewing and evaluating, people's situations?
Yeah, it's a good question, and it does sort of get into, and what I always like to explain to everyone when especially first-time home buyers, right? They always want to get the full understanding of the policy, which we're more than happy to go through and explain line item by line item. But what's most important is if you're buying a standard insurance policy, right? So I'll use Connecticut as the basis, but it does apply to every single state, right? So every state in the country has an insurance department that is part of their government, and there's an insurance commissioner of every single state. And what that insurance department, the insurance commissioner and his or her staff is tasked with doing is making sure that they look over every single insurance policy that's written in a state, as well as work with every carrier that is licensed to do business in that state. Now, let's take something like a homeowner's insurance policy. There's there's more than that, but there's two main homeowners insurance policy forms. There's an HO3 and an HO5, and the only difference between them is the perils they insure against. The HO3, which is the standard insurance policy, every HO3 that is written and issued in Connecticut has to include the exact same coverage. Okay. You can't take anything out of the policy. That is there to protect the consumer, right? So, the perils that are insured against are going to be identical in every HO3 policy. Now, you can add additional perils to that policy. You can enhance the policy, but you can't strip it down. And that is truly there to protect the consumer. There are excess and surplus lines homeowners insurance policies, which is what you have to utilize when you can't get a standard homeowners policy. So similar to what we were talking about in California or Florida, it does happen here in Connecticut as well, right? Maybe you've had a number of claims in recent years. Maybe a home is vacant. Maybe a home is too coastal. For whatever reason, there are times that it comes up. You can't procure a typical standard homeowners policy. And then when you're at that excess and standard market, they don't have to adhere to the same rules as the standard and admitted policies that you would typically see. So that's when it really comes into play, where you're weighing out which perils are you covered against. But that's always the biggest comment that I like to share with all homeowners, especially first-time homeowners, is look, this contract is identical whether you purchase it from this company, that company, or the company, two roads over. It's going to be the same policy. I like to enhance it. I like to beef it up and add in more coverage that you're additionally protected. But at a bare minimum, at least you know that you do have the same coverage as the other companies are putting in place. And then from there, I would say the biggest concern that often comes up is that dwelling coverage limit, right? So when you have a homeowner's policy, the dwelling coverage is the amount of money that the insurance company believes it will take for them to rebuild your home. And as we were talking about earlier, it's often not the exact same as the purchase price. Here in Connecticut, a lot can change depending on which zip code or town you are in. You can go a couple miles and all of a sudden the real estate value is going to change dramatically from one town to the next. Whether that has to do with proximity to the water, proximity to the highway system, the schools in the area, whatever it may be, the property values do change dramatically. But the building costs really don't. At the end of the day, yes, maybe there are some builders that are going to tack on a little bit of extra money per square foot in certain towns than they will in others, but for the most part, they're all relatively the same. So just because your purchase price is one number doesn't mean that the dwelling coverage is going to necessarily go associated with that. We have beautiful homes located on the water that the purchase price may be sky high, but the dwelling coverage may be a portion of that. Because at the end of the day, what they're buying is the real estate. They're buying the beautiful views, but to rebuild their home, it's not going to cost that much money. So it can vary dramatically in one way or the other. So that's always a big conversation with people, is explaining how the dwelling coverage limit is determined, how the price per square foot is utilized. And so often, these insurance companies, they're working with local builders. They're reaching right out to them and saying, hey, what is this going to cost? And that's how they're getting the parameters. And that's how they're getting an understanding as to how they need to value these homes. Because so often when a home there is a total loss, a lot of these insurance companies unfortunately find out that they were extremely uninsured. The homes were insured for far less than what they should have been. And now, granted, one of the most important coverages that I will always suggest on any homeowner's policy is, first and foremost, you want guaranteed replacement cost coverage. So on your homeowner's policy, that dwelling coverage limit, as I alluded to, that's what the insurance company believes it's going to cost them to rebuild your house. But as we just saw in California, if there's going to be total destruction to a certain area, that dwelling coverage limit is no longer going to be sufficient, because that hyperlocal inflation is going to push everything through the roof. So what you want to have on the policies is guaranteed replacement cost endorsement. And what it says is, we believe the dwelling coverage limit is what it's going to cost us to rebuild, but in the event that the rebuild value is higher, we will go to whatever amount it costs to rebuild this house, regardless of cost. That is the number one coverage that for me is a necessity on every homeowner's policy. There are some insurance companies that won't give you guaranteed replacement cost coverage. They'll cap it at either 125% of the dwelling coverage limit or 150% of the dwelling coverage limit. Whatever is the highest amount you can get from an extended replacement cost perspective, I highly suggest it. Because heaven forbid there is total destruction to a single area, that dwelling coverage limit is probably going to be far from sufficient. And if the insurance company is only going to rebuild to that amount, you could then be out of pocket hundreds of thousands of dollars.
Yeah, it's crazy, and for a lot of folks, their home is probably, especially as you're growing and early in your life, like probably the biggest asset these people own. That's where
so often,
right?
It really is. The amount of money tied up in real estate, regardless of where you are in the country, especially in recent years, as the real estate market has gotten so remarkably strong, that the vast majority of people, especially if they're not an extremely high earner, most of their money's tied up in their asset of the house, and you want to make sure that it is adequately insured, because that could be the nest egg for a great number of people.
Yeah, and so with that, and that's why I always urge people to get a good relationship with an agent like Kyle, who can talk you through these things and shed some light on the realities of how they're designed and what you're protected or not protected against. So at least you're informed and empowered and to make the right decisions, as opposed to what I often hear is like, how can I find the cheapest cost to it?
Well, unfortunately, as Tom and I, we've spoken about before, the insurance industry has become commoditized. And unfortunately, the vast majority of people who reach out to us, especially people who are needing insurance for the first time, the only thing on their mind is cost. And until you get to know the insurance world a little bit more, you don't know what else to ask for.
Yeah.
So often people make it seem as though they're really only focused on cost, but then once you start talking with them, they'll often let you know, well, I just don't know what else to associate insurance with. I don't know what else I should be looking for, other than I don't want to pay more than I feel I need to. And then it's through education, like everything, and you explain, okay, this is what I'm suggesting and this is why. These are the scenarios we see play out. And like all of us, I don't want anyone to pay more than they have to either. I just want to make sure people are in the right position in the event that a loss occurs. I want to see them made whole. I don't want to see anyone then be bit on the back end because of a lack of education.
Yeah, absolutely. What's that adage, like, price is what you pay, but value is what you get, right? And
Absolutely.
So, you got to make sure you're getting the right value for the price, right? That I think is you've helped me with even my own personal policies and be able to kind of balance that, right? So you kind of have the appropriate coverage for what matters to you and your situation for the best price, right?
Oh, there's no doubt. And then having, working with independent agents like us who have seen hundreds of thousands of claims and we've seen how they've played out. And, we will remove carriers if we feel that they're not handling claims to the right perspective, right? Because we're only as good as our word. And when we're telling our clients, hey, in the event that you have a claim, you're going to be covered and this is how you're going to be covered and this is how it's going to go. If one of our carriers were to ever not live up to those expectations, we would quickly get rid of them. And that's one of the important things of working with a trusted local insurance advisors, because they've had these experiences. And then in addition to that, my cell phone is filled with people in the trades, because heaven forbid something does happen to one of our clients' homes or their properties, their commercial buildings, their rental properties, whatever it may be. We're usually their first call. And what we always tell them is, hey, before we can determine what we're going to do from an insurance standpoint, let's just make sure this is remedied. Let's have the water shut off. Let's have the fire put out. Let's have the roof be covered in tarp. So let's make sure that we're in the right spot. And typically any insurance advisor should certainly have contacts within their community to make sure that they can get people to their clients' homes or properties as soon as possible to help remedy whatever disaster is happening.
That's great. That's great. Well, listen, Kyle, this was great. We only got to half of what I wanted to cover, so I'm going to have you come back on so we could talk around the business side.
Absolutely, we'll do that one in person.
Yeah, that would be awesome to kind of share that, because there's probably a lot of other things too that are unique there for business owners to consider around protections and anything that I've seen both sides of it. There's just different complexities, different things to consider. So definitely we'll have you come on. But man, I really appreciate you coming here and sharing your wisdom around a topic that I think a lot of people really need to pay more attention to. It's one of those overlooked areas, I believe, in a lot of insurances, but in particular around property and casualty. It's just people are too casual around it, and they're putting themselves and their families at significant risk, and they don't even always know it. And so, Kyle, I really appreciate you spending a little time and sharing all the great information. And so how best for folks, if anyone wants to learn more about you and Charter Oak and kind of what you're doing, how best to kind of get in touch with you guys?
Oh, I really appreciate that. And yes, I welcome any and everyone to give me a ring. And what I always say is, when someone already has policies in place, the easiest thing for us to do is let's learn first about those policies and let me know how those mesh with you and your family. And then let's talk about different risks that we're not seeing. And at the end of the day, what's most important is to get a bunch of different options and comparisons to then be able to go through that Excel sheet and say, okay, this is the coverage that I need. How can we make this work in the right way and make sure that we're with companies that are going to have our back in the event of a claim. Our website is coagency.com, so C as in charter, O as in oak, agency.com. I can also be reached by phone at 203-655-9766. And I can always be reached by email. My first name, Kyle, K-Y-L-E, and that is at that same coagency.com. But thanks all for listening, and Tom, thanks so much for having me.
Yeah, absolutely. We'll definitely be sharing those contact points within our show notes, and definitely reach out to Kyle. He's a great guy, and definitely give you good advice to kind of help you decide how to protect the things that really matter to you. So thanks again, Kyle, for joining us.